Okay, I'm very excited to have on the Goldstein on Gelt Show George Sisti, who, like yours truly, is also a certified financial planner. And I discovered George because I was reading an article that he wrote in Market Watch called "You Don't Need to Own Individual Stocks." So, George, tell me, why don't you need to own individual stocks?
Well, Doug, I think the reason you don't want to own them is because they contain additional risk that you don't need to take. The stock market is risky enough, it's volatile, and you can't avoid that. You can't avoid the volatility as a stock investor. But by owning individual stocks, you take on individual company risk, and owning individual stocks offers no expectation that you'll receive higher than market returns. So I see no upside and only downside.
So let's drill in on this, because overall, and the listeners to the Goldstein on Gelt Show know that I've said that myself, but there are a lot of people on the other side who say if you do your research and you find a really good company, a company that's been increasing its dividends every year and that's got a huge market share and a great brand, why wouldn't you invest in a great company like that?
Well, let's make a comparison. Let's say on the one hand, an investor has a portfolio of individual stocks that he's picked through his research. And on the other hand, we have a passive index investor who owns the Vanguard Total Stock Market Index Fund. The fact is, the Vanguard investor who owns the total market owns all the good companies. The second point I would make is that the person who has done his research to find quote-unquote good stocks, I would assume that an efficient market where prices are determined by very intelligent, capable, profit-seeking individuals, those good prospects are already reflected in the price. So there's no advantage there. You have to see something that everyone else is missing. Everyone else is not understanding the future prospects as well as you do. That's highly unlikely, especially if it's just, an individual investor picking stocks.
Right, who might be getting his news from a newspaper or the internet, by which time it appears there, it's certainly old news.
Or even if it's your company. A lot of people have an affection for the company. They think they understand the company better than outsiders. But just because you work indoors doesn't mean you have insider information. If you work for a publicly held company, the idea that what you see inside the company isn't known by observers outside the company is also naive.
But what about the people who say something like, I own an iPhone and I've got an Apple Watch and I love the technology and, I always love buying things that Apple makes and I just want to be part of their future because they seem on the cutting edge. What's the problem with that?
Because you don't see anything that everybody else doesn't see. First question we have to ask is, why do we own stocks? Well, I would say I own stocks because I want to be a participant in the economy. I want to own a small portion of the economy. Now, if you invest in individual companies, what is the reason for owning that stock? It has to be because you think it will do better than the total stock market index fund, let's say. Well, how would you know that? Doesn't everybody know about Apple? Aren't there iPhones and iPads everywhere? So aren't their future prospects already priced into that price of the stock? I think the answer is yes. So you don't have any knowledge that you can exploit to your advantage.
I think that's a great way to describe it, which is it might be a great company. Nope, and we're not disputing that. And it might even be that it's going to have a good long future, but it doesn't mean that the price today it's on sale and you're going to make a big profit on it. So let's dive into the next step, which is then owning mutual funds or ETFs. There are thousands of these types of securities out there. How can a person choose?
Well, we know you can't choose past performance because past performance is no guarantee of future return.
Amen.
if you can't use past performance to determine future performance, then you can't use past performance to find outperforming active managers. That leads me to assume that the best strategy and the low-cost strategy is to own the total market through an index fund, and then, as John Bogle says, gladly accept the returns that the markets freely give us. Some years there'll be good returns, some years there won't be good returns, but over the long haul, the individual stocks have been the best capital growth asset individual investors can own. And over the long haul, owning the total market has proven to be a very beneficial strategy for individual investors.
We're talking with George Sisti, a certified financial planner who I found from his Market Watch column, but also interestingly, he in a former life was a United States Air Force pilot and a pilot at United Airlines. So, George, one of the things that I've always been impressed with in pilots, and frankly I just hear it in your voice, is their ability to not sway from their path when things like emotions overtake them. In other words, if a pilot is afraid, he can't all of a sudden just do something crazy. How do you teach that, or how do you guide your clients to make sure that they're not letting emotions guide their investing instead of their intelligence?
I think that's why our clients hire us. You can't teach people to be unemotional. But if they trust you and take your advice, you can modify their behavior so that they don't respond to the noise, to the daily noise of the market. And that's the biggest thing that we can do as financial planners to help our clients. Because our clients' long-term return is going to be a function of two things. Number one, the most important thing is going to be their asset allocation of their portfolio. And number two is going to be their emotional responses to what happens in markets. And unfortunately, for most do-it-yourself investors, the second component, the emotions, often overrule a good portfolio allocation. So that's what we need. Our clients need to trust us, and they need to trust us because we're trustworthy and looking out for their best interests. And they learn that over time, I think.
Yeah, I think that is true, and it is difficult to step aside. In fact, oftentimes people say to me, they say, Doug, you must buy stocks. You know what's going on in the market. And I say, it's true, I like the stock market, and I do watch them, but 95% of my money is handled by money managers who I oversee, and they're trading in ETFs. But I don't want to be the guy who's actually pulling the trigger on my own money, because I know, just like everyone else, for my own money, my emotions will get involved. And it's better just to be able to step away and look at the big picture, like the asset allocation, and really spend more time focusing on your goals than on what's going on with interest rates today. But of course, interest rates today for a lot of people, and probably a lot of our clients, are a big problem because they're getting into retirement years, or they are retired, and they had been counting on getting interest on their money, but now it's basically zero. How can you help people like that out?
Well, my strategy when people retire is to have a portion of their portfolio in what I call safe money, or dry powder. And by that I mean U.S. Treasury securities, investment-grade corporate and municipal bonds. And we're going to spend down from that side of the portfolio, whatever their drawdown might be every month or every quarter. It's going to come from that, quote-unquote, safe money. Then whatever allocation we have to stocks, we just let that do its own thing. We reinvest the dividends in the stock funds. And that way they're not in a position where they sell shares of stock or stock funds in a declining market to pay the light bill this month. And I think that strategy makes a lot of sense to people. And it doesn't really matter. You don't have to be very wealthy to do that. It depends on how much you're spending, how much is coming in, the difference of the two. So it could work for somebody of moderate or modest means, or it could work for somebody who's very affluent. And if you can get 5 to 10 years of drawdown money as a retiree, then you can hopefully withstand the emotions of market volatility in your retirement years.
So just to clarify, you're saying put aside 5 to 10 years of spending in more conservative investments like CDs, treasuries, bonds, munis.
Absolutely.
And then the rest of the money you can invest in a riskier pattern.
Right. So this is what I would say. The past is a guide to the future. It's no guarantee for the future. We know by using Ibbotson data that there's never been a 15-year period where the S&P 500 or domestic stocks, as represented in the S&P 500, had a negative rate of return. And there's never been a 20-year period where the S&P didn't beat inflation. So if somebody could put 15 years away, if they had 15 years of safe drawdown money the day they retired, I would think they could be very confident that that portfolio allocation was very robust for them. Now, there's no guarantee that the next 15 years, starting the day you retire, won't be the first 15-year period where stocks lose money. But, life's not fair. But the strategy makes sense, and it's a prudent strategy. That way, whatever's left over is your equity allocation for growth. So in low interest rate environment, since we're going to spend down principal more than the interest from our fixed rate investments, if interest rates are 2% instead of 5% like we'd like to see, it just requires a slightly larger allocation to the safe money, because the great majority of the money we're going to spend in retirement is going to be spending down principal. So I look at it as a total return strategy rather than a live off the interest strategy like my parents did.
Mm-hmm. Right, I guess because in different times you have to have different strategies, but one thing that certainly is for sure, especially for the people who are younger listening to the discussion, is that you've got to build up that savings and start when you're young and put aside as much as possible. George, it's first of all, I like your approach because I think there are many strategies that people can follow, and yours certainly sounds very prudent, but the fact is it is a strategy that's easy to explain. It's not that it's simple, it's just that it's easy to explain and something people could actually do. But in the last few seconds, as we are just about running out of time now, tell people how can they follow you and learn more about some of your other ideas?
Well, I usually write 2 columns a month at Market Watch on the Retire Mentors page where I explain my thoughts about investing and financial planning and retirement planning. And I also have a monthly newsletter I write that you can go to my website and find. The website is OnCourseFP.com. That's short for On Course Financial Planning. And there you can click on the newsletter and link, and you can read the newsletters or sign up for the newsletters.
Okay, and we will put a... sorry, is there another one?
No, that's it.
Okay. All right, so listen, we will put links to your pages at the show notes of today's show at goldsteinongelt.com. George, listen, I really appreciate your taking the time, and I hope we'll have a chance to speak again soon.
I hope so too, Doug. Thanks for the time together. I really enjoyed it.
You are listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.